Welcome to The Explainer. Today we're unpacking one of the most jarring, absolute head-scratching paradoxes of our modern financial era. Imagine opening two different newspapers on the exact same day. One is telling you the world is fracturing, supply chains are under siege, and global peace is literally hanging by a thread. But then you look at the other paper, and it's telling you the stock market is celebrating like it's the greatest economic boom in human history. So how on earth can both of these things be true at the same time?
We're looking at a complete and utter contrast here. On one side, we've got the very real threat of oil oscillating near $120 a barrel, enduring what is arguably the greatest supply interruption in the entire history of the oil market. Geopolitical tensions are boiling over. And yet, on the flip side, the S&P 500, the Nasdaq, massive companies like Apple, they're all hitting all-time record-breaking highs. It feels completely disconnected from reality, doesn't it? Well, today, we're going to decode exactly how this illusion is happening.
Section 1. A world in contradiction, or as they say, un mondo in contraddizione. Okay, let's dive right into this. The number 5, that is the golden key to this entire stock market mystery. Just 5 tech companies are doing virtually all of the heavy lifting for the broader market index. So while the headlines are out there screaming that the entire market is booming, the actual reality is way more concentrated. What's truly wild is seeing exactly who these 5 companies are and what they've pulled off. We've got Google up 44%, Broadcom right there at 43%, Amazon at 36%, Nvidia at 29%, and Apple up 17%. These massive double-digit gains are essentially acting as a brilliant glittering smokescreen, because if you were to just pull these specific tech giants out of the equation, the rest of the market has basically been standing completely still. And that brings us to a really stark historic anomaly. Right now, we are witnessing the highest ratio ever recorded of individual companies hitting 52-week lows, while the overall index somehow hits all-time highs. What that means is underneath the surface, a massive portion of the market is actually struggling. And you know the last time we saw a discrepancy this extreme? January of the year 2000, right before the dot-com bubble completely burst.
Section 2. The Middle East Fracture. La frattura in Medio Oriente.
So while Wall Street gets propped up by just a handful of tech stocks, the real world is dealing with some heavy macro geopolitics. To truly grasp the looming threat to oil and, by extension, the global economy, we have to look at the shifting alliances in Riyadh. Behind closed doors, Saudi Arabia's Crown Prince Mohammed bin Salman is quietly distancing Riyadh from Washington's policies, and there are 4 really critical, unpublicized reasons for this pivot. First up, Saudi Arabia is prioritizing regional stability above all else. They know exactly how fragile prosperity can be. Second, they desperately need to protect their oil cash flow to fund their massive 2030 infrastructure project. Third, they absolutely want to avoid creating a disintegrated failed state right on their border in Iran. And fourth, they've actually vastly improved diplomatic ties with Iran thanks to some mediation by China back in 2023. They're even discussing a potential Islamic alliance.
Now, Iran is actively exploiting these shifting alliances and the resulting regional fracture. They've essentially set up a toll booth over one of the most critical waterways on planet Earth by creating the Persian Gulf State Authority. This newly created agency is designed to authorize passage, collect tolls, and really institutionalize control over the Strait of Hormuz. And just to put that into perspective, that route handles a staggering 1/5 of all global oil commerce.
Section 3. The oil risk. Il rischio petrolio. Okay, so we have an artificially inflated stock market on one side and a geopolitical chessboard rearranging itself around crucial oil choke points on the other. But what does this actually mean for physical barrels of crude oil and ultimately for your wallet? Looking at analysis from institutions like Morgan Stanley, we see 2 totally extreme viewpoints. On one side, commodity specialists are sounding the alarm, calling this the largest supply shock in history. Totally apocalyptic. On the other side, generalists are super optimistic, just brushing this off as a temporary political shock that'll fix itself. But the truth is right in the middle. The market prepared for this by putting massive amounts of oil at sea, but we are now steadily, quietly draining that 8 billion barrel global storage cushion. Let's ground these massive billions of barrels numbers into everyday reality for a second. 1 in every 11 barrels of oil produced globally ends up inside an American car. 1 in 11. That is an astonishing statistic. When supply tightens and U.S. gas creeps toward that psychological threshold of $5 a gallon, history shows us that it triggers massive demand destruction and rapid, drastic political shifts. The pressure on the everyday consumer becomes immense.
Section 4. The Wall Street Anomaly. L'anomalia di Wall Street.
And this brilliantly illustrates our original question. If oil reserves are draining and geopolitics are shifting, why is Wall Street just completely ignoring all of this? Let's break down the mechanics of why markets can stay so disconnected from the physical economy. First off, inflation artificially boosts nominal profits. A store might sell the exact same amount of stuff they did 50 years ago, but because of price increases, their revenue looks massive. Second, companies just keep executing stock buybacks and paying dividends, which creates profitability even with zero GDP growth. Third, massive American multinational corporations are capturing the 3% real growth happening outside the US in places like India and Mexico. And finally, as we talked about, the massive expansion in market valuation is being driven almost entirely by big tech.
Speaking of big tech, we absolutely have to look at the money being poured into artificial intelligence right now. The hyperscalers, these massive tech giants, are spending unprecedented amounts of cash. Last year, capital expenditures were around $437 billion. This year, they are projected at a staggering $800 billion. That's an 83% jump in just one single year, purely betting on the future of AI.
But here's the part that is truly shocking: where that money is coming from. Absolutely all of it. 100% of these tech giants' free cash flow is going straight into data centers and AI infrastructure. Not 70%, not 80%. Every single extra dollar they produce is being fed directly into the AI machine.
So the crucial point is this. We are looking at three highly unpredictable outcomes for this massive AI gamble. Scenario 1. Valuations stay high, but future returns for investors end up being kind of mediocre. Scenario 2. AI truly is the revolution we've been promised. Profits absolutely explode, and these massive valuations are entirely justified over time. Or Scenario 3. Investor sentiment changes, confidence drops, and the market crashes violently, just like the dot-com bubble in 2000. And the absolute truth of the matter, nobody actually knows which scenario is going to play out.
Section 5. Your action plan. Il tuo piano d'azione. So we've got an unpredictable AI boom sitting right on top of a fragile, oil-driven geopolitical crisis. Before we get to the steps to protect yourself, we have to acknowledge that these global macro forces are going to hit your local reality. If oil stays above $100 a barrel for a few more months, inflation is going to remain persistent. Central banks, like the European Central Bank, will have to respond. The rate cuts we were all hoping for might stall, or rates could even rise. And that directly impacts things like the spread between European bonds and, most importantly for a lot of us, the interest rate on your personal mortgage. Because we cannot predict the future, we have to rely on a solid, unbreakable process. So here is your 3-step anchor strategy to confidently weather the coming volatility. Step 1 is your emergency fund. Step 2 is geographic diversification. And step 3 is maintaining your accumulation plan, your pack. Let's break these down real quick. Step 1 is incredibly simple, but I'm telling you, it's absolutely vital. Ensure you have a 3 to 6 month emergency liquidity cushion sitting safely in your bank account. Why? Because when oil spikes, or rates jumped, or the market corrects, having cash on hand means you will never, ever be forced to panic sell your long-term investments at a loss just to cover your daily living expenses. It's your ultimate safety net. Moving on to step 2, and this is how you build your defense. You must diversify geographically. The extreme market concentration we discussed earlier is a uniquely U.S. problem right now. If you look outside that top-heavy U.S. index to markets in Europe, Canada, or Australia, you're going to find much more reasonable, stable valuations that aren't entirely dependent on just 5 tech companies. And finally, step 3. Stick to your pack, your accumulation plan. Do not try to time the market out of fear. If the market hits new highs, awesome. If the market crashes tomorrow, you keep buying exactly as your plan dictates. Long-term consistency is what actually builds wealth. It's not about trying to guess the peaks and valleys based on terrifying news headlines. Always remember this: the stock market grows over the long term for structural reasons. We're talking inflation, real global growth, corporate profits, and these forces, they're going to continue. The investors who successfully built massive wealth over the last 50 years, they didn't have a crystal ball. They simply held their course and trusted their structured process when everyone else around them was screaming in panic. Preparation always, always beats panic. We've covered a massive amount of ground today, from the shifting sands of the Middle East to the server farms of big tech. And look, we know the noise in the media is only going to get more intense in the coming months. So I want to leave you with this one final thought to reflect on. Are you truly prepared to stick to your process when the headlines get louder? Thank you so much for joining me in this explainer. Stay focused, stay disciplined, and I will see you next time.